Investment in securities market is subject to market risks. Read all the related documents carefully before investing.
Welcome to yet another episode of The Big Picture. It's been long. We have been missing action for the last almost 2 months now. So a lot of water has gone under the bridge since our last conversation. And today we want to talk about investing in IPO bound companies. See, one of the recent phenomena that we are noticing is retail investors have got fancy to the idea of investing in companies which are planning to do their IPOs in the next 6 to 12 to 18 months. Now, is it a great idea to invest, or what is that investors are missing? What should they be doing? It's something that we want to talk about today. So, when you look at a company which is bound for an IPO, an unlisted company, so there are multiple issues with those companies, with those investments. One, the information asymmetry is at the highest. So what do I mean by information asymmetry? What the existing investors know versus what are the potential buyers aware of, right? So primarily because the disclosure standards for a private company, for an unlisted company versus a company which is listed in markets is far different. The disclosure standards are much higher for a company which is listed versus a company which is unlisted, which means that most prospective investors do not have access to the right kind of information. The second thing is, a typical private company is not subject to scrutiny by professional investors and money managers. So say, be it a report from a broking house talking about the company, its business, its management and everything else, or a show of hand by large institutional investors who invest in those companies. So what happens is, both these things don't happen. The company is not subject to these kind of continuous scrutiny. The third thing interesting is, as a retail investor, you do not really have access to this management or even their thinking, because these privately listed private companies which are unlisted do not really come out and interact with the general investing public. So as a retail investor, you suffer from A, the problems of information asymmetry, B, lack of analyst scrutiny, professional investor scrutiny, 3, a lack of access to management or their thinking and whatnot. Now, but typically when we look at it, as an institutional investor, as an investor in private markets who invest in these unlisted companies, they have methods and tools to overcome these disadvantages. So what are they? They do complete due diligence. So they employ big four accounting firms to do due diligence, and they do a legal due diligence. They also do what we call as sometimes forensic audits and multiple things. They do channel checks. They spend enough time with the management, and they have access to the management as part of the process. They have access to what we call as a data room. So a private institutional investors have ability and tools and processes to overcome these disadvantages, which clearly retail investor or even smaller HNIs do not have. So what drives these investments? Predominantly it's driven by FOMO, right? The fear of missing out. We tend to think a company which is doing private company which is likely to list in the next few months, we tend to think that I'm missing something if I'm not investing in those companies. But is it really true? Is it that your investments in a private company, unlisted company which is out there, filed its DRHP for an IPO, has it been great always? The answer is mixed. The answer to that question is it's been great sometimes, it's not been so great. So if you take an example, we have had multiple IPOs of large unicorns in the last few years. So a case of a fintech in one of the IPOs which happened in a few years ago, we saw that stock trading at a price much below its IPO price, right? But then the IPO was very well subscribed by retail investors, and even prior to that, investors were getting onto the pre-IPO bogey, right? And second thing, take a case of a consumer tech company, a similar thing happened. See, these companies, if you really like them, they were available to you post-listing at a significant discount to pre-IPO prices, right? And same thing, currently the latest one which happened in the last 10-15 days is case of a financial services company where the IPO price was at a significant discount to the last traded, the last prices known in the unlisted space. So message from us is loud and clear here. This is not something what one should practice as an investment strategy. You will be better off as a retail investors once the company lists, it seasons, there is multiple, couple of quarters of performance which you can track, and maybe there are a lot of, there are a lot of analyst con calls. Even you could participate in those con calls now that we see a lot of retail investors attending analyst meets and things like that. So it might make sense for you to wait till the company lists and maybe evaluate the management, evaluate the company, the industry, everything else in that period and take a call. So net, stay away from companies which are likely to go public in the next few months. And another thing, the caveat, another issue that I never mentioned so far is some of these companies never see the IPO. That's the biggest risk that you take when you invest in a company which has filed its IPO prospectus. Thank you.